Hello, my name is Sheila Worthy, and my group members and I will be presenting our financial report on Crocs Incorporated. I'll first begin with a brief summary of the executive summary. Crocs is a global footwear company best known for its lightweight, comfortable clog made from a material called Crosslite. Their mission centers on delivering comfort, fun, and innovation, and their products, including both the Crocs and Hey Do brands, are sold in over 85 countries. The company emphasizes values like sustainability, inclusivity, and creativity, which guide both its culture and its product design. Crocs operate in the consumer sector, specifically in apparel, footwear, and accessories industry. Because sector involves non-essential goods, Crocs' performance depends heavily on the consumer preferences and the overall economic conditions. It's also a very competitive market, with major companies like Nike, Adidas, and Birkenstock offering similar comfort-focused products. For our competitor analysis, we look closely at Birkenstock. Birkenstock is a long-established footwear brand known for its cork and latex footbed and focus on orthopedic comfort. While Crocs lean into a bold design and trend-driven collaboration, Birkenstock's focus on the timeless style and premium materials, making it a strong competitor in the comfort footwear market. Overall, Crocs' continued success comes from its ability to balance comfort while adapting to the change in the consumer trends.
I'm going to start by explaining the daily stock prices. For starters, we have Crocs daily stock prices from around 2010 to 2017. The stock was pretty low and steady, mainly sitting between $5 and $20. During that time, the company wasn't performing super strong and investors weren't really invested. But around 2018, things started to pick up. New products and better marketing helped the stock climb, and by 2020, it was sitting in the $40 to $50 range. Then, during COVID, since everybody was buying comfortable shoes, the stock blew up and hit almost $180 in 2022. After that peak, it came down but balanced out between 80 and 120 from 2023 through 2025. So overall, Crocs had a huge turnaround, way more valuable now than it did in the early 2010s, even though the price moved up and down along the way. Next, I'll be talking about the weighted average cost of capital. Our calculated WACC came out to 8.8%, and Bloomberg's number was 8.7%, so they were almost identical. We got that by using 72% equity at 10.2% cost of equity and 28% debt at 4.9 after-tax cost of debt. So what does this mean? Crocs needs to earn at least 8.8% on investments just to satisfy leaders and shareholders. Since that percentage is kind of high, it also shows Crocs is using a good bit of debt. And when there's more debt, investors expect a high return. Moving on, we also broke down a few important financial ratios. The quick ratio is 0.59, which is below the benchmark of 1, meaning Crocs might have trouble covering short-term payments with just their liquid asset. The asset turnover ratio is about 0.9, which is more than double the competitor range, and that means Crocs is really efficient and they can generate a lot more revenue for every dollar in assets. But the PE ratio is 6, compared to its competitors that is about 21. A lower PE means the investors don't expect as much future growth and aren't willing to pay as high of a price for their earnings. So basically, great efficiency, but lower market confidence and not the strongest liquidity when it comes to the ratio analysis. And lastly, we looked at the cash flow, where Crocs is putting their money and how their finances operates. Crocs doesn't pay dividends, but instead returns value through share buybacks, and the most recent repurchase was about 560 million. They also issued 1.02 billion in long-term debt while paying back around 352 million. So overall, the debt increased. Their debt to equity ratio of 1.6 to 1 backs that up, and they rely a lot on debt financing. So overall, Crocs is a debt-heavy company prioritizing buybacks over dividends or issuing new stock. In conclusion, Crocs is efficient and the stock has grown massively over the years, and they're taking on a lot of debt to fund growth, but there's a lot of upside and definitely some risk too.
To start us off, this first slide is going to give us a little background information on the financial stability of Crocs. Their stock prices is sitting around $79, and that tells us that investors are confident in their future earnings, so Crocs will keep performing well. They have 56.5 million shares outstanding, which represents ownership spread across investors. One thing to note is that their debt to equity ratio of 1.62 means for every dollar of equity, they have $1.62 in debt. So they're somewhat leveraged, but that can also increase returns if the company continues to perform well. Finally, their quick ratio of 0.59, which shows that they don't have enough liquid assets to fully cover short-term liabilities. So that's a risk that should be kept an eye on as we move through the financials. Building from that overview, this next slide looks deeper into their profitability and market perception. We can see that Croc's book value per share is about $35, but with a market value of $79, you can see that investors clearly value Crocs well above asset value and believe that the future earnings are worth paying a premium for. Revenue grew 3.5%, showing steady demand, and free cash flow per share came in at $13.29, which is great because it shows they generate a lot of cash internally. Cash flows also rose 13% over the year, which gives Crocs more flexibility with investments and debt payments. And even though price earning ratio is only 6, which normally means there is an undervaluation or market skepticism, Crocs' financial performance shows strong execution overall. Continuing from that, this slide focused more on operations and efficiency. Crocs generated 923 million in free cash flow, which means they have room to invest, pay down debt, or grow comfortably. They also spend around 40.7% of their revenue on production, which is very efficient for a retail footwear brand and supports high margins. Inventory turnover is of 4.4 times a year, tells us products are selling and restocking at a healthy pace, and profit margin of 23% shows Crocs keeps almost a quarter of every sale dollar in profit, which gives them a strong competitive position. Moving into earnings and the balance sheet, this slide highlights how well Crocs is positioned financially. They have 68.6 million in short-term debt and 1.63 billion in long-term debt, mostly from buying Hey Dude. But their free cash flow makes that manageable. Net income sits at 950 million and EBITDA at 1.2 billion, which really shows solid operational performance. And with their equity book value being 1.8 billion, shareholders will retain meaningful value even in a liquidation scenario, which supports investor confidence. This final slide puts all the numbers together in one place in a simplified table. Crocs shows strong profitability, efficient resource use, and competitive performance, especially compared to peers who don't turn assets into sales as effectively. Overall, these financial indicators support the idea that Crocs is a stable, growing, and has long-term potential for shareholders.
All right, I'll be covering our part three, going over our valuation and recommendation. First, we calculated Croc's total debt by combining short-term and long-term borrowing. That totaled about 1.7 billion. This matters because debt must be deducted to determine how much firm value actually belongs to shareholders. Next, we applied the constant growth valuation formula to the Croc's free cash flow, growth weight, and WACC. Interestingly, the model gave us a negative result, but that doesn't mean Crocs has a negative value. This happens when growth rate exceeds the discount rate, meaning that the formula breaks mathematically. So it signals that we need to rely on alternative valuation approaches. Because of that limitation, we took Bloomberg's enterprise value, which captures the market's estimate of the Croc's total worth, and that number is about 5.64 billion. From there, we calculated Croc's intrinsic equity value by subtracting debt from enterprise value. That gives us roughly 3.94 billion or about $69.70 per share. When we compare that to Croc's actual market price around $79, we see that the stock trade is at a premium. And that tells us that investors expect Crocs to continue performing well beyond the model's assumptions. We calculated the market value added, which is what premium investors assign beyond the intrinsic value, and that came in at $9.33 per share, reinforcing investors' confidence. To summarize, Croc's intrinsic value is about $69.70 per share, and its stocks trades are closer to $79. So it's not undervalued, but investors are paying extra based on expectations of growth, branding power, and operational strength. So because of that, our recommendation is that it's a cautious buy for long-term or growth-focused investors. While strict value investors may want to wait for a price closer to the intrinsic value before entering a position. Here are the project's references and AI disclosures explaining how we use AI for clarity and support. Thank you for your time. Have a great day.